Okay, I think we're live. It's that little red button up there.
Yep, that's it. Hello. Good
Hey,
morning.
so I wanted to introduce Miss Allison with the Mortgage Collective group, right? That's what y'all call
Yep.
yourselves. All
Mhm.
right.
Yep.
I've been seeing y'all social media page a lot on Instagram, and
Mhm.
I've seen you've been working with some people that I know in the industry, and wanted to reach out see if you can help me and the team with some valuable information, and also spread out the word about what's going on in the market and how they can purchase homes as well.
Absolutely. Yeah, it is my pleasure. Thank you so much for having me on.
No problem. No problem.
So
So
this
you,
morning we're going through Mortgage 101. Is that right?
yes, ma'am.
Okay, perfect. Perfect. Well, I have just a small presentation, and then obviously we'll leave kind of room and space for any questions. And then, Michael, obviously, if you have anything you want to interject or add on to what I'm sharing, please do that. But we'll just kind of give you an overview of ultimately what the mortgage process looks like, where we begin, and some other important things to keep in mind as you are getting ready to purchase a home or you have clients that are getting ready to purchase a home. So, I am Allison. I'm part of the Mortgage Collective. This is our team. We're a group of loan officers. This is our loan processors is on here as well, and our loan officer support team. So we are a group of gals that have a combined 40 plus years of experience. I've been in lending here in Houston for over 13. And so, yeah, we do. What I believe is a really good job at caring for people as they move through the mortgage process and ultimately really care about education. We want to, pass that along to the people that we partner with, but also clients as well, because the mortgage process can be a little overwhelming. And it's our job, I believe, to kind of demystify that and make it streamlined and simple to understand. So I'll kind of go through a few slides of ours. When we are getting ready to go get pre approved, the first place we begin is by having a conversation. And that conversation allows us to understand what is the client's wants, needs, goals, fears, etc. So a large part of our conversation initially is based around what is your monthly payment goal? Because just because we can get you approved for $1 million house doesn't mean that that payment is what's going to make sense for you and your family's goals, right? So we want to start with what is comfortable for your family financially, and then reverse engineer that into the actual approval amount, what loan types make sense, and all of those things. And we also talk through down payment amounts, what makes sense as far as like out of pocket goals are concerned, because that also opens up us to understand, okay, what products do we need to be keeping in mind for that specific product, for that specific client and their needs. And so we go through all of that together in that initial conversation. And then also just kind of preparing the client for what the next steps look like as far as actually applying and going through the pre-approval process, which is obviously step number 2. The application is done in many cases, whether it's myself or other lenders on our website. We do most of our applications electronically now, just as an industry as a whole. It's pretty quick. It's like 15-20 minute process to get the application completed. We typically do a soft inquiry to credit, just as an initial glance at their financial picture. And then when it makes sense, we'll do that hard inquiry. There's obviously no cost in applying for a mortgage pre-approval as well, and certainly no obligation either. You don't have to use that specific lender that you're applying with. And so that's step number 2, is actually going through the application process, allowing us to collect documents, which we'll get to at a later slide. And then step 3 allows us to process everything and then ultimately present that client's pre-approval options. If there's anything that's holding a client back from getting pre-approved, we create a game plan for that client. And so that game plan could be something like credit repair, savings plan, debt reduction, what they should be focusing on in the next 3 to 9 months potentially to prepare for that future purchase. So they're ultimately walking away either approved with a valid approval letter, which is good for 4 months, or they're walking away with a really solid game plan. And so that's always our goal, is to get those two objectives in place. And if the client is in a game plan, we also have a really diligent follow-up process to make sure that we are staying on top of that client and just being a guide alongside of them through that. So bear with me. Okay, so next we've got basic loan products. These are the most like run-of-the-mill products. So jumbo, which is higher priced loan amounts. Then we've got conventional, FHA, VA, and USDA. Those are like the most standard ones that we see. I'll break those down really quickly. FHA is technically designed for a first-time home buyer. It's 3.5% down. Credit score minimums on that are 580. However, even though it was designed originally for first-time homebuyers, you can actually use the FHA loan more than one time in your home buying journey. So you don't have to be just limited to being a first-time homebuyer.
I have a question for that.
Yeah.
Sorry to interrupt your flow.
Yeah,
So first-time home buyers, they normally ask us, realtors or brokers, whatever you want to call us, about first-time home buying programs.
mm-hmm.
So is there really any first-time home buyer programs, or are there just programs in general and we do what's best?
Yeah, absolutely. So there's still tons of first-time homebuyer products and actually down payment assistance programs that are available for first-time homebuyers. But then there are some that are down payment assistance programs that are available on multiple purchases. Like it doesn't have to be your first-time purchase to allow that. At its core, most down payment assistance programs are either FHA, conventional, or VA. And then they have a down payment assistance rider or second lien that goes with that loan. And that's what allows that down payment and or closing costs to be funded on behalf of that buyer. So there's still tons of programs out there. There's state entities like TSHAC or TDACA. But then there's also federal ones like Chenoa and other more popular ones. There's also Harris County Grant. So there's lots of programs out there. And all of those programs have very specific requirements. And so it really is just going to depend on what makes sense for that specific client as well. And the grants can be anywhere from 2 to 5% of the loan amount. So if they're doing an FHA loan and that down payment is 3.5% and they get a 5% grant, then 3.5% of that is covered by the 5%, and the balance of those funds gets applied to closing costs. So it's a really cool program. I'm seeing a lot of buyers use down payment assistance programs right now just because of where our economy is at. It's harder to save right now. And so they need that little bit of a buffer to help get them into a home. And those down payment assistance programs are really great for that. So tons of options in that space.
All right. Thank you.
Yeah. And then VA is obviously designed for veterans. Most people don't know that you can have more than one VA loan open at a time. So you don't just have to have one VA loan at a time to be able to use that program, which is really cool. Conventional is typically for, and bear with me, VA doesn't have a minimum credit score requirement either, which is really cool. It used to be 580. They did away with that. So it literally is whatever the system allows for that buyer to get approved at. So I've had somebody as low as a 570 or below still get approval on a VA loan. It is the most lenient and most forgiving of the loan types. So it's really, really popular product for that reason from a lender perspective. Conventional, as little as 3% down. And when I say that, that's based off of the sales price of the home, as little as 3% down. And the credit score minimum on that one typically begins at 620, but the more favorable pricing and interest rates and all of that usually comes at 640 or above. Really, it's like closer to 700 and above, but that 640 and above break allows for a little bit of better interest rates. USDA is 100% financing. You still have closing costs with the USDA loan, but the cool thing is it allows your down payment to be covered, and this is only allowed in rural areas. So the property has to qualify for USDA financing depending on where it's located. And there's actually a map on the USDA website where you can type in the property address and it'll tell you whether you're eligible for it or not. And jumbo is usually for those $1 million net properties that allow just different financing options. And so that's not considered a conventional loan at that point. It's considered a jumbo loan. Interest rates are a little bit different on that, and down payment amounts can vary as well. These are your basic run-of-the-mill loan products. This is where 90% of our buyers land in the market today as far as products are concerned. Now, there are
I have a question.
Yeah.
Sorry. The USDA loan. I know another agent that's using that to, like a buyer's using that to purchase their listing, and they've been under contract for three months pending. So, is that normal, or how does that work? I hate to bash USDA, but I'm just trying to figure out what's going on with that.
Yeah, so no, that's not normal. Now, USDA does take historically longer to close. Usually, the turn times are known upfront for USDA. Like when we submit a loan to USDA, we know, okay, it's a 45-day, closing average. So they should know upon submittal what their current turn times are. But that seems like a longer length of time. Doesn't seem normal.
Right. Okay. I appreciate
Yeah, we can talk offline about that because that's interesting. I want to know more. These are additional products. So these are going to be for more niche clients' needs. Obviously, we talked about down payment assistance, but there's also things like bank statement loans, DSCR loans, which is debt service coverage ratio loans, 1099 self-employed loans. So those three, bank statement, DSCR, and 1099s, these are all really popular with entrepreneurs because we don't actually look at tax returns to qualify the client. We use either their 1099 income or the proposed rental income on the home to qualify the client off of, or deposits into their bank statements over a 12-month period. And so we see this with self-employed clients who write off all of their money on their returns because they're trying to save on taxes. So we actually see a lot of real estate agents use these products for themselves because they ain't trying to pay those taxes. So they write all of that off, obviously, or as much as they possibly can. So these are really popular products. The credit score requirements kind of vary on them, and down payment amounts vary as well, but it's really cool option to know that they don't have to submit their tax returns to qualify like you would on a traditional loan. You've also got physician loans. These are going to be for your doctors and physicians. These are 100% financing in a lot of cases. There's a renovation loans, which allows you to buy a distressed property and roll in the cost of repairs to the loan amount. And then plenty of first-time homebuyer products out there as well. We kind of talked about that. It falls more under the category of down payment assistance, but I-10 loans for those that have an I-10 and not a social security number. So it is, it's really cool to know that there's just options out there depending on the client's needs or wants. Any questions on this?
Well, yes. As far as
Okay.
the self-employment, I get a lot of self-employed people. Also, so self-employed and ITIN, right? Self-employed. How does that work with, like, say, like realtors that write their stuff off, or contractors that write their stuff off? So they got to go back and adjust their taxes and pay taxes and come back to it, or how does that work?
No, so with these products, we don't look at tax returns at all. We are just simply looking at what are your deposits over a 12-month period into your bank statements, your business bank statements, and taking an average of those deposits, so that we're not looking at your bottom line on your tax return on what your net income is. The 1099 kind of works similarly in the sense that we're not looking at your returns to see what you did or did not claim. We're just looking at what is your income on your actual 1099, and averaging that out as well.
Okay, that makes sense. As far as the ITIN,
Mhm.
um, what are the qualifications for that?
So it's going to vary, because there's a few different broker channels that we use for that. We have a 10% down product, which is a little bit unique because typically the down payment requirement for ITIN is like 20 plus percent. Usually it's like 30 plus percent, but we actually have a 10% down product. Credit score needs to be on the higher end. I think it's 720 on that one. Um, and so it's just going to depend again on the client's needs. And that will tell us what broker is going to make the most sense to get them connected with.
So do y'all broker them out, or do y'all do y'all originate loans inside, or y'all brokerage?
Both.
Both. Okay.
So we are a direct mortgage lender first. Most of our products are done in-house. So FHA, conventional, VA, USDA, all of those standard products are done in-house. And then we have on some of these additional products, some of those are done in-house as well. But then there's certain products that we don't have an in-house product for, but we have broker channels for, and we can submit those out to those broker channels.
Okay, understood. And usually, and last point on this ITIN, usually when I get them, they'll have the money,
Mhm.
but it's hard to pull up the credit. Is there any way around that, or we just have to have credit?
Credit is definitely going to be important, and what we'll try and do is kind of give them a game plan around that as well, so that they're expediting their efforts.
Gotcha. Understood.
Sweet. Um, Standard list of documents needed: 2 months of bank statements, 2 pay stubs, 2 years of W-2s, driver's license, and then we'll usually, depending on their income structure as well, if they're self-employed, we'll get 2 years of tax returns instead. If we're qualifying for just a normal conventional loan, and then we'll get HR contacts to do verifications of employment if they're like an hourly employee as well. So it's just going to depend on really their kind of financial picture. And when they go to complete the application, our application is a static loan application, meaning the answers that they provide on the application tell us and tell the client exactly what we need from them. So it kind of builds a custom list for them as they move through that process.
Understood.
Awesome. And then really quickly, I always like to touch on credit score as well, because that's such a large part of the approval process. And there's a lot of mystery around, or just lack of information or misinformation around credit scores. Most of our credit score monitoring sites that we use are not accurate. They're consumer credit scores. So things like Credit Karma, even some of the apps like Experian and otherwise don't provide you with your FICO credit score. And so I always suggest my favorite out of all of them is myfico.com, because it allows you to see what your actual mortgage credit score is. And so if somebody is wanting to just self monitor in preparation for a home purchase, I always suggest myfico.com. And that's my favorite. That's one I use and then suggest clients to use as well. If they're not quite ready to apply with a lender and all that stuff, and maybe they're a year or so out, but still want to like see what's going on with their credit score, that's my favorite to suggest. Now, as far as importance of items for credit scores, you'll see on this graph that payment history is the biggest one. If you have a late pay, even if it's accidental on a line of credit, it can truly, truly disrupt your credit score. And usually, one late pay on a credit score can put your credit anywhere from like 10 to 20 plus points below what it was before that late pay occurred. And so payment history is the most important of all of your factors. Um, if you have a late pay, usually you don't see your score repair or rebound from that late pay for 12 months. So one late pay can truly put you back 12 months or more. Amount owed, that's basically your utilization ratio. So how much of your credit are you using, or are you abusing it, or are you using it responsibly? And so a good rule of thumb on revolving debt, like a credit card, is to not spend more than 30% of the available limit. Um, the more ideal number is like 10%, not spending above 10% of the available um, limit to you. Length of history is really important. New credit, and then your credit mix or types of credit. Like, do you have a couple lines of revolving credit and then maybe an installment debt like a car? But those are less important. The more important is how much of your credit are you actually using, and are you overusing it? And then your payment history. So that's something that I always like to make clients aware of. And I would say too, if you are in preparation of purchasing a home and do just want to get an idea what your credit is outside of a monitoring app like myfico.com, I like to always have those conversations up front and take a look through your report. When I was getting ready to purchase my first home, I literally pulled my own report and I went through line by line to make sure that it was accurate. And I actually found an item that did not belong to me and one item that was incorrect. And I adjusted those items and it made my score go up like 20 points or more. I can't remember. It was a long time ago. But so it's always smart ahead of time to literally comb through, and honestly, just once a year as a consumer, to scrub through your credit report, because 60% of Americans have some form of inaccurate information on their credit report, whether it's something that doesn't belong to them or something that was already rectified and is still reporting. So that is definitely something that I suggest as a mortgage lender in preparation for a future home purchase.
My FICO, does that use like the same back end tool things they use on the Credit Karma, or is it complete? They use like Experian, Equifax,
So
like straight from the
actually,
source?
um, on myfico.com, there is consumer credit reporting reports like Credit Karma, but they
Mhm.
actually have sections. So they have your car credit score, they have your mortgage credit score, they have your credit card credit score, which is your consumer score. So like when I log into my FICO, the first um, credit score that they display is your consumer one. So that would be probably the equivalent of what I would see on Credit Karma. But then if you go down a couple tabs, you'll see your mortgage credit score. And if you open that up, there's likely a large disparity between your consumer credit score and your mortgage credit score, because it's two different types of algorithms in those reporting models. And so that's why you're if somebody applies and they're like, yeah, my credit karma score is 800, and then they apply with me and I'm like, well, it's actually 620. They're like, what? It's because it's not even the same set of data. It's completely different. So that's why I think it's really important to dig into that ahead of time, just so that you're not caught off guard when you actually go to purchase a home.
Is that a system that's free for them to use, or they gotta pay like a
So
monthly
my FICO,
subscription?
there's a subscription. There's two platforms. I do the premium, which I think is like $30 a month. So it's definitely on the higher end. But if you know that you're preparing for, a future home purchase, it's in my mind a well, worth it investment.
Makes sense. Thank you.
Yeah, absolutely. And so the last thing that I want to kind of go through is ultimately the cost of waiting. I know I talk to clients every single day, and the first thing that clients ask about are what are interest rates doing? Because it is the most prevalent concern that most clients buying today have. Because they are higher than what they have been in the past 3 years. And so we want to make sure that we're just being educated on what that cost of waiting looks like, because we know once interest rates do improve, home prices are going to go up because that pent up buyer demand that we have right now is going to be released because suddenly interest rates are better. Buyers are going to start coming forward again and being ready to purchase, and that is going to drive home prices up again. So I just did a quick side by side of what your monthly payment would look like at today's interest rate, and it's slightly below today's interest rate, but let's just say as a general example, 6.99% on a $350,000 home, your payment is $3,035.60. If we wait until rates come down to, let's just say, 5.99 at a $400,000 price point, your payment is actually higher at 3201. And so it really is just a good frame of perspective on like what that looks like to wait for more favorable interest rates. And I will tell you candidly, right now, a lot of clients that are applying are locking in at a 1 to 3% below market interest rate just because of the negotiation opportunities that exist in our market, which, Michael, I'm sure you're seeing a lot of you and our team. But if we can get a seller to pay for, a buy down cost for a buyer, it can truly change their monthly payment. And then they're buying at today's price versus next year or the years after, which is going to be higher ultimately.
Right. Absolutely right. Yeah. I get a lot of people that want to wait. Actually, a handful of pre-quals, just wait
Yeah,
for interest
absolutely.
rates to drop.
Yeah,
But
yeah,
I keep telling them it's not going to make a difference. Actually, it's going to make a difference in when you try to purchase. Like you said, if they wait, they're going to be having issues like we had a couple years back, to where
right,
everybody can be multiple offers and everything. So we do have a lot of pent up demand. So
right,
yeah.
right. But yeah, that's kind of it on my end. Ultimately, I would say it always makes sense, even if you are a year or two away from hopefully purchasing, to consult with a mortgage lender so that you are getting the clearest game plan possible in place and are the most prepared that you can possibly be.
Well, I definitely appreciate your time. Where can everybody find you?
Yeah, so I am known as your mortgage friend on most social media platforms. And if you find me on social media, you will find my email and cell phone number and all that good things to reach out to me directly.
Okay, sweet. All right, so we're going to wrap up things, and I'll talk to you on the back end. I appreciate you coming out and helping us,
Yes.
showing us how everything works for your end. I hope you have a blessed day and make it to your where you got to go to.
Thank you so much. I appreciate you for having me.
Thank you.